Hello and welcome to another trading video from our Healthy Trading Habits series. My name is Justin Paolini, Head of Trader Development here at FCI Markets. Before we get started, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. With that said and done, let's get started. Just a little bit about me. You've probably seen this in other videos. The important thing is that I spent most of my career on the retail side of things before graduating into the institutional side and working with experienced traders here at FCI Markets and sending trading signals to institutionals with our partners at 3C Analysis. So this means that I've probably made every mistake in the book twice, and since I survived, I'm probably in a better position than many to guide you through the hurdles of trading. I want you to know that all the education, all the content we're putting out here at FCI Markets has one objective, which is to expand our trading desk. We are looking constantly for talented traders to join us, either at our premises in the UK or remotely. So all the education we are pushing out is directed at helping you simplify your trading habits and become a more consistent trader. Today we are going to talk about expectancy in practice. Most traders want to see an equity curve like this. It's a known fact. Okay, this is one of the equity curves I took randomly from my FX book. But to be honest, in the institutional space, we've seen an equity curve like this. This is what Bernie Madoff's equity curve looked like before he blew up in 2008. And as you know, it was a scandal. It was actually something like a Ponzi scheme. What is wrong with equity curves like this? With so many trades in it, you can't really see the detail unless you're experienced. But what you can see is that there are these little spikes, these little downward spikes that aren't too evident, after such a length of time. But when you go and you look at the risk metrics, they become very evident. The herd, which is the majority of retail traders, only want to see, profits, profits, profits. This is the only chart that they look at, and they don't look under the hood to understand how these profits are generated. That is what we're going to see today, and there are strong implications for remaining consistently profitable as a trader. So breaking down the risk metrics. Okay, the first thing that any professional will do when looking at a track record is he will go and look at the drawdown. How are the drawdowns compared to the overall return? Now, the one thing that really stands out here is that as the account got bigger, as this trader continued to amass profits, the drawdowns got progressively larger. And these are drawdowns that happen once in a blue moon, but when they happen, they take out a whole bunch of profits. Okay, so there is something inherently wrong with this strategy. This is a negative skew strategy. Okay, this is the same kind of issue that long-term capital management had. Okay, it's a famous story from 1998. There were the smartest people in the world behind that hedge fund, and it works until it doesn't. It works until it breaks down tremendously. So when you see strategies like this, you know that their longevity is only a matter of time. And in any case, there is much more risk than meets the eye in these strategies. The first thing that I want you to see is that the average win is only a fraction of the average loss. This raises red flags. The second thing is that when you see a trading system that has a huge win percentage, you know that you are facing one of these left tail strategies, one of these negative skew strategies, and you have to be extremely cautious because you know that the manager's profitability is only dependent on his win rate because he is picking up small profits and he is exposing the account to very large losses. How large can the loss become? Well, we still haven't seen the end, because as the account grows, this manager is just continuing to let his losses grow. The other thing, which is one of the most popular risk metrics in institutional space, is the Sharpe ratio. But let's go forward first, before we go and identify exactly what is the Sharpe ratio. We were talking about expectancy. Now, the expectancy is the typical return, typical profit or loss per trade. Now, obviously, your expectancy should be positive. The calculation for the expectancy is average profit times win percentage minus the average loss times the loss percentage. Okay, so typical profit minus typical loss. And this should be positive. But there are some caveats to this. Notice this is from a trader who is with us here at FCI Markets and who is a growing trader. So he's not ready yet to manage funds, but he's a growing trader and he's working well. This is what he presented to us in terms of a track record with his expectancy. Now notice how initially, if you just look at the money, it seems that he's doing a good job with his expectancy. But if you go and you turn it into percentage terms, you notice how his expectancy is actually decreasing, much different than in money terms. So the first lesson is that it's not about the money. You can modify the expectancy equation and make it look better than it actually is if you're trading outsized positions and you get lucky. So your expectancy will look good because your average profit seems huge compared to your average loss. The other thing that you can do to skew the expectancy in your favor is to have a huge win rate. And that is exactly what was happening with this trader too. His win rate was very high, although he had other issues, and we're going to see that soon. This is the issue. What I'm showing you here is the second port of call when somebody shows you his expectancy. The rolling average profit to average loss ratio. So the expectancy curves that we saw just now come from this first trader. Now look at his average profit over average loss ratio. Notice how we're not even at 1. His profits are, they were a quarter of his average losses. And he got better and better and better, but still his average profit is only half of his average loss. Okay, so it means that basically if he makes 5 pips on average, his losses are 10 pips on average. Okay, that's not satisfactory. Vice versa, another trader that's with us has achieved a situation where his average profits are more or less 1.5 times the average loss. Now what this tells you is that the trader doesn't need to have a high win rate in order to remain profitable. And this is key. Any trader that has an average loss that's larger than the average profit, like this fellow, is basically profitable only because of his win rate. Now vice versa, any trader that has an average profit that's much larger than his average loss can afford to have a 40 or 50% win rate. Okay, that's important. It tells you how much pressure there is on the trader to be right with his timing, to be right with his entries. And that's a lot of pressure. So you need to have your profits that are much larger than your losses. The other thing is that your trade expectancy should be stable and consistent. Okay, and this is actually my own record for my own trading over the course of 3 years. And as you can see, I tried to keep it as consistent as possible. And there are many traders that are much better, that will have a much stronger expectancy than I have. I just wanted to show you this example of consistency and longevity over the course of 3 years, not over the course of 3 months, but over the course of 3 years. And hopefully it is a bit of inspiration. The other thing that I'd like to point out is that your expectancy is only one part of the analysis of a trader. One thing that's very important to us here at FCI Markets is the Sharpe Ratio. The Sharpe Ratio is a metric that is used in the institutional space to compare apples to apples. The Sharpe Ratio is a metric that allows you to compare your performance to your standard deviation of performance. So it compares your performance to the volatility of your performance. Now, stated otherwise, it is telling us how good you are at achieving returns per each unit of risk. And I know there are limitations to the Sharpe ratio, like there are to any risk measurement that you can use, but it is pretty good in showing whether a trader is consistent or not, because the Sharpe ratio really does require consistency in a trading method in order to have these kind of numbers. This is again from my own trading, from that same track record that you saw before, and the Sharpe ratio to the last trade was over 2. Of course, it took some time to get that started, and I also had a section where I was way below 1. We will evaluate track records of any trader that has a Sharpe ratio above 1, but this is really what it takes to be an exceptional trader. And this shows anybody who's trying to evaluate your performance that you deliver consistently above average returns per unit of risk. So the Sharpe ratio compares apples to apples, and this is independently from your trading strategy, from the asset class you trade. You can trade forex, you can trade indices, you can trade commodities, whatever you trade. Your Sharpe ratio allows us to compare your strategy with other managers. It also is a good measure of uncertainty because, like I said before, it tells you how much units of performance you're making per each unit of risk. Okay, a Sharpe ratio of 1 means that in general, per each unit of risk, you're making 1 unit of performance. A Sharpe ratio of 2 tells us that per each unit of risk, you're actually making double that. You're making 2 units of performance. So you're an extremely good risk manager. And since trading is all about managing your downside, it's all about managing risk, the Sharpe ratio does offer that kind of information. It is good in terms of measuring that uncertainty and that risk. So finally, if you have to take just a few pieces of information away from this video, here they are for you. In your trading strategy, try to make sure that your losses are small and infrequent compared to your gains, okay? Everything is relative. You could have very tiny profits. For example, you could have 5 pip profits, and some people might say, well, that is too small. If you're a scalper, it might be average, but it's not small unless you compare it to something. So you need to compare it to your losses. If your profits are 5 pips, but your losses are 2 pips, then in reality your profits are quite large compared to your losses. So keep your losses small and infrequent compared to your gains. The second thing is that you should aim to run your profits every time it's possible. So this goes back to your trade management. Okay, your trade management should allow you to swing for the fences. It should allow you to trail your stops, but allow your profits to mature. Allow the trade to run if it's going to run. There's no ego. There's no attachment to the trade. If the trade is in profit and it comes back down and it stops you out at break even, that's fine. It only costs you time. What we don't want to do is we don't want to have this idea that we have to make great profits, but then we also let the profits come back down and get eaten up and actually go into a loss. Never let a winner turn into a loser. And also, if you have a 3, 4, 5 R winner, don't let it come all the way back down to break even. Secure that. Secure a piece of that or something. You should have a trade management strategy in place that helps you trail your stops, locking in profits as the market progresses in your favor. And this doesn't mean you have to have a long-term strategy. This can be applied to the intraday, it can be applied to scalping, it can be applied to multi-day, to anything. The principle is always the same. And the third thing is you should cut your losses quickly. So don't let your losses reach 1 R. Okay, so that means that if you're risking 20 pips on your trade, 1 R would be 20 pips. Okay, so if the market goes up, let's say 15 pips, okay, and it comes back down to your entry, and you didn't cut the trade, and the market starts going below your entry, cut it before it gets to 1 R. Because the sooner you cut your losses, and the smaller your losses are, the easier it is to get these bigger gains compared to your losses. Okay, it's all relative. I hope this was useful, but if you do need further guidance, here are a few things that you can do. Number 1, subscribe to our Thought Leadership blog. Just come on to our portal, click on this button, enter your email, and subscribe, and you can receive our Thought Leadership pieces directly into your inbox. The second thing is follow our Twitter calls. We try to issue only the most relevant market-moving information and some charts each day. And finally, if you want to transition from being a profitable retail trader to a professional trader, then come to the FCI Professional Training Academy. And know that we are serious about our dedication to you, and we offer all Academy participants a fully funded account. That's how confident we are that we can help you progress to the next level in your trading career. So come on over and take a look. And for any questions, as usual, we are happy to hear from you. Get in touch, send us an email to client.support@fci-markets.co.uk, or give us a call. And if you are based in the UK, just come and visit us at our headquarters. We're happy to hear from you. This is Justin Paolini for FCI Markets. Over and out.